These days, we are all hearing the news every day about layoffs, especially in technology companies. Over 32,000 people have been laid off from US tech so far this year. Tech companies that boomed during the pandemic are seeing dramatically falling revenue. This is especially true of tech companies in e-commerce, real estate, and those closely related to the stock market. Tech companies doubled layoffs and hiring freezes in 2022 as compared to 2021. And we are hearing about how job cuts at tech companies are crashing the housing market. But now that real estate values are crashing, what about all of the people who work in real estate? Well, as you might imagine, there are layoffs in the real estate industry as well. And this is especially true of real estate technology companies. Redfin, Opendoor, OfferPad, and Zillow. All four of these companies have basically been a dumpster fire since the start of 2022. All of them started buying portfolios of single-family homes near the height of the real estate bubble. Actually, they may even have been the cause of the bubble. Or, at least the catalyst. But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. If you have been watching the events unfolding in real estate, you probably already know that Redfin is having a disastrous 2022. Shares in Redfin plummeted to a fresh record low this week. This after an Oppenheimer analyst downgraded Redfin shares. Oppenheimer also said that Redfin's business model was fundamentally flawed. Shares in Redfin cratered by almost 10% on Monday after the Oppenheimer report was released. Oppenheimer analyst Jason Helfstein cut his rating in Redfin shares to underperform from a hold equivalent rating. "I see room for further pain. I set a price target of $1.30 per share," said Helfstein in a note to clients. "We believe that Redfin's business is fundamentally flawed, as the company continues to use a fixed cost model for agents," Helfstein wrote. "This prevents the company from optimizing margins when the housing markets decline and limits share gains when markets rebound," Helfstein continued. "Any comments the company can share about its stock price move will be addressed on its earnings conference call on Wednesday after it releases results," said Redfin. Shares in Redfin have plunged around 91% so far this year. Real estate technology companies have been decimated by the housing market's slowdown. Rising mortgage interest rates have stymied the U.S. housing market. Opendoor Technologies announced an 18% headcount reduction. Shares in Opendoor fell 14% after the Oppenheimer report was released. Shares in Compass declined 6.3% on the same day. Zillow Group cut 5% of employees. If you follow this channel, you already know the economic and financial narrative of the times. The United States economy is teetering on the brink of recession. Inflation is raging. The Federal Reserve is aggressively raising interest rates this year in order to fight inflation. Higher interest rates are negatively impacting the affordability of houses. And first-time homebuyers have basically been frozen out of the market for a few years now. But, now as housing sales are slowing due to higher interest rates, thousands of people who worked in the real estate industry are facing job cuts. The housing market was booming during the pandemic. That was a result of the loose monetary policy of the Federal Reserve. And the increase in the money supply basically caused a run-up in the prices of assets. This is called an asset bubble, when too many dollars are chasing too few assets. Well, the bubble is now bursting, to say the least. The entire real estate ecosphere is facing widespread layoffs with steeper cuts expected in the months ahead. This includes job cuts at some of the biggest companies in the real estate industry. Max, Redfin, Wells Fargo, Zillow, Opendoor, OfferPad. All of these companies have announced layoffs in past few months. This comes to thousands of jobs that are being lost. The current crash of property values and real estate jobs is equivalent to what we witnessed during the housing crash of 2008. The rate of the standard 30-year fixed mortgage is now over 7%, which is more than double the rate 1 year ago. Higher mortgage rates increase the monthly payment to own a house. And, so houses are now even less affordable. This basically prices many buyers out of the market. This is a stark and speedy reversal of fortune. For the past 2 years, the housing-related job market has been red hot. Work from home and record low interest rates drove tech workers out of California and into relatively lower-priced housing markets. A tsunami of buyers entered the market looking for new homes, especially in the Mountain West. Sales of existing homes peaked in 2021 at their highest level since 2006. The resulting spike in housing demand created a lot of new jobs. And it was, frankly, quite a bright spot in what was otherwise a pretty bleak pandemic-era job market. A lot of the new employees came from industries that were hit hard by the pandemic. This included hospitality, healthcare, food service, and education. During the pandemic, over 200,000 new real estate agents were minted, according to the National Association of Realtors. Refinancing of existing mortgages also drove demand for loan professionals. Mortgage companies hired employees with reckless abandon. The number of loan originators or processors leapt 31% during the pandemic, according to a report from Simple Nexus. Despite all of this doom and gloom, the overall job market continues to be strong. But the collapse of housing prices could have a ripple effect on the rest of the economy. Fewer people can afford to buy homes. So, overall spending is going to be lower. This means lower spending on durable goods, such as appliances, furniture, and renovations. The mortgage business has probably been the hardest hit during this housing downturn. That is because refinancing and home sales have plummeted. Almost 40 mortgage companies have shut down. Overall, thousands of jobs in the real estate ecosphere have basically vaporized. Tech layoffs are a primary reason why home prices in technology hubs fell dramatically this year. San Jose, California is down 10%. Seattle is down 7%. San Francisco is down 7%. Los Angeles is down 4%. Denver is also down 4%. Zillow has sold its portfolio of properties at a substantial discount. Zillow stock is down almost 70% from its 52-week high. The CEO of Redfin has warned that his company is quickly selling off properties in its portfolio. Redfin stock is down over 75% in 2022. The United States housing market is at a significant inflection point with many cities significantly overvalued. Boise, Idaho is 72% overvalued. Austin, Texas is 67% overvalued. Ogden, Utah is 64% overvalued. Las Vegas, Nevada is 61% overvalued. Atlanta, Georgia is 58% overvalued. Phoenix, Arizona is 57% overvalued. Provo, Utah is 57% overvalued. Experts predict that house prices could fall by up to 25% over the next few months. On the positive side, this could be an opportunity for first-time home buyers. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.